Hello, everybody, and welcome to the Sustainable Materials Management Webinar Series, a joint effort between the National Recycling Coalition and the Pennsylvania Recycling Market Center. My name is Wayne Bowen. I'm the Program Manager for the Recycling Market Center and will serve as your moderator today. Today's webinar topic is an update of recycled metals commodities markets, and our presenter today is Joe Pickard. Following his presentation, we will conduct a question and answer session. If you have a question or comment, please use the chat Q&A located on your control panel on your screen. You may also use this feature to request assistance if you're experiencing technical difficulties during the webinar. Please note that an edited version of the webinar will be made available for viewing via YouTube links on both the National Recycling Coalition and Pennsylvania Recycling Market Center websites. And also note that the Pennsylvania Recycling Market Center, its affiliates and funders, and the National Recycling Coalition assume no liability resulting from the use of any information provided during this webinar. This webinar is only provided as an informational tool, and no discrimination is intended and no endorsement by these organizations is implied. So Joe's resume is full and broad, and I'm going to dispose of that at the moment. You've seen his bio on our promotional material, so I'm going to skip that. We're going to get right to the presentation because it's a good one, and I anticipate a lot of Q&A. So Joe, I'm going to hand it over to you.
Okay, that's great. Thanks very much, Wayne, and good afternoon, everyone. Hope this all finds you well and safe. I know that when Wayne and I had initially started talking about doing this webinar earlier in the year, certainly a lot of the focus at that point was on China and how China's adjustment on allowing especially copper, brass, and aluminum scrap imports into the country starting July 1. That was the focus of a lot of discussion within the scrap recycling industry. Certainly things have changed a lot in the last month, as we're all too familiar with. And so I wanted to switch gears just a little bit. The focus is certainly still on metal markets, but wanted to step back for a minute and just give a little broader context as to sort of what's happening in the economy, what's happening with labor markets and with the manufacturing sector. Talk a little bit about the stimulus measures that have been enacted in response to the current crisis that the economy is facing. And then go a little bit deeper into a sort of broader market reaction, and then talk specifically about the metals markets, both ferrous, stainless, non-ferrous markets as well. And then just talk a little bit about what ISRI is doing to try to assist our members as they try to navigate these difficult times. And then I look forward to answering any questions that you all might have at the end of the session. And Wayne, if that's okay with you, I'll just hop into these slides if that's okay.
Yep, go ahead.
Okay, great. And I'm sure you guys will all have access to these slides, but if you have any specific questions after the session, feel free to contact me, and I'll put my contact info up at the end of this presentation. So as I indicated, let's start with a little bit of the economic context, and my apologies ahead of time for just how depressing these numbers are. And I know it gets difficult to listen to, but I think it's important to sort of set the stage with the economic context as we're thinking about what's happening with manufacturing and metals markets and scrap metal demand. So a couple of major things, obviously, that were moving markets last week. One was the huge spike in initial unemployment claims. The other one was the president's signature on the CARES Act as the fiscal stimulus in the amount of $2.2 trillion. And then also a number of monetary policy announcements from the Federal Reserve and other central banks. But looking at the economic data, I'm sure you're all familiar with last week's reporting on initial unemployment claims. 2 weeks ago, I should say, the number of claims had increased from about 210,000 to about 280,000, which was a large spike. And a lot of forecasters were expecting that claims last week could increase to 1 million or 2 million. Some were expecting more. The number, of course, came in at 3.28 million, the largest number of initial, excuse me, unemployment claims in our nation's history by far. And then the concern is how long we can continue to see those level of claims. I think when you're looking at the consensus forecast for the report that's going to come out Thursday of this week, the expectation is that initial unemployment claims will be about 2.8 million, but we could easily see another report this week with 3 million or more claims. Unfortunately, last week's report showed that unemployment claims by state showed that Pennsylvania had the largest increase in weekly claims. According to the Bureau of Labor Statistics data, there were 378,908 new unemployment claims in Pennsylvania for the week ending March 21st. That's not on a seasonally adjusted basis. That 378,000 is actual numbers, not adjusted for seasonality. Again, the highest level in the nation by a good measure, followed by Ohio, New Jersey, Michigan, Massachusetts, and California. And I should also point out that I'm a Pennsylvania native originally from the Philadelphia area, so it's especially painful for me to have to report on the spike in claims in the state of Pennsylvania.
Why do you think that's so high, Joe?
I think because it's, one, there's been a lot of manufacturing activity that sort of serves as the backbone of the Pennsylvania economy, which has been impacted. I'll talk a little bit about what's happening with steel mills and other manufacturers later in the report. And I think it's a big state, and there's also been a lot of confusion, not just in Pennsylvania, but elsewhere about what constitutes an essential business. And so I know from companies and that I talk to in Pennsylvania, that has been a big issue. Not that it's only an issue in Pennsylvania, but it's been a source of significant concern. And my expectation is we'll see Pennsylvania sort of lead, for lack of a better word, diminish over other states as other states' unemployment claims increase.
All right, thanks, Joe. Sorry for the interruption.
No, anytime. I don't stand on formality, so ask any questions you want as we go along here. Just quickly, the question then becomes, how long can these unemployment claims decline from the current level? And I think the expectation is that they will actually decline fairly rapidly, which is not the same thing as saying that the economy overall is expected to recover rapidly. I'll talk about that a little bit, but I think part of it is that, remember, these are initial unemployment claims that we're talking about. And there's only so many initial claims that you can get to before we have massive levels of unemployment. So this chart, for those of you who are following online, shows the potential diminishing levels of unemployment claims expected basically over the course of the next month. Okay, so that's the labor market conditions. And again, we're going to have the next initial unemployment claims report out on Thursday. And then we have the big jobs report from the Labor Department out on Friday, which will show the March employment numbers, which are expected obviously to show a contraction in non-farm payroll levels and a significant increase in the unemployment rate. One thing to keep in mind is that the Labor Department collects most of that data for the jobs report in mid-month, and so probably won't reflect all of the job losses that we're seeing in the weekly numbers. Happy to answer any questions you might have on that. Moving on to the manufacturing side of the economy, the numbers have not been stellar either, and we'll get the actual national Purchasing Managers Index numbers from the Institute for Supply Management later this week. Market Economics also puts out composite and manufacturing PMI numbers. And again, those tend to lead changes in US GDP. And IHS Markit reported last week that US private sector firms indicated a marked contraction in overall business activity in March, following the escalation of the coronavirus outbreak. The overall decline was the steepest recorded since comparable survey data were available in October 2009 and reflected widespread falls in activity across the manufacturing and the service sectors. Again, sorry for the depressing news. One of the major concerns in the US, and I think this is why a good portion of the CARES Act was looking at support for small businesses, and there had been actual additional measures announced by the Small Business Administration prior to the CARES Act approval last week. But just because of, one, what a big percentage of small business constitutes in terms of the size of the US economy, and also just how cash strapped so many small businesses are. So if you can see on the chart on the left side of the screen, it's asking how long can small businesses survive if sales stopped completely, excuse me. A little over 20% said less than 1 month. About 34% said 1 to 3 months. So in other words, more than half of all small business in the US that were surveyed indicated they could not survive more than 3 months if sales stopped. Now, sales stopped is, would be abrupt and not necessarily what a lot of scrap recyclers are looking at, a complete cessation of sales, but disturbing nonetheless, especially given the fact that small businesses employed nearly 59 million people in 2018, according to the Small Business Administration. That's about 48% of all US employees. And if you look at it by just the number of firms, small businesses are the vast majority of companies in the United States. And for more than half of them to say that they couldn't operate without new sales for more than 3 months, I think certainly got the attention of policymakers. And that's why you're seeing just vast stimulus measures that are being enacted, both on the fiscal policy side and on the monetary policy side. I won't go into all the components of the CARES Act that was signed on Friday by President Trump. The Wall Street Journal has a pretty good breakdown in the chart on the left-hand side about the percentage of, the dollar values in terms of loans to businesses, small business loans, deferred taxes, household payments, extension of unemployment insurance, and so on. And the National Law Review actually has a pretty good paper on it as well in terms of the key CARES Act provisions like paycheck protection, how the loans and loan guarantees actually work, some of the business and individual tax provisions, and other related credit, loan, regulatory, and patent and trademark provisions. I would also just do a quick plug, if you don't mind, Wayne. Our ISRI chief lobbyist, Billy Johnson, actually did a webinar specific to the CARES Act late last week, and that's available on the ISRI website at isri.org if you want to hear more detailed information about not just what's in the package, but also Billy kind of takes the pulse of what's going on Capitol Hill and what the expectations are for additional stimulus going forward, because they're talking about, as you've probably seen, another round of a potential fourth legislative package to provide additional support on top of the trillions of dollars that have already been provided. And that's just the fiscal side. If we look at the monetary policy side of the equation, I won't go through all of these programs, but I think the first one on screen is the most important one, and that's unlimited quantitative easing. Previously, the Federal Reserve had indicated limits on purchases of treasuries and mortgage-backed securities as they attempted to provide more liquidity into the system. This current QE program is unlimited, which is unprecedented in terms of monetary policy response. Other things they're doing is support for commercial real estate, support for consumers and businesses through a credit facility, support for corporate bonds, for consumer credit, for municipal finance, and then finally support for small and medium-sized businesses through their Main Street Business Lending Program. That's just kind of the tip of the iceberg in terms of monetary policy responses, because it hasn't just been the Federal Reserve, it's also been central banks around the world that are trying to coordinate their policy actions. The first one on March 20th was the coordinated central bank action to enhance the provision of dollar liquidity, which had become a major concern as demand for dollars had increased dramatically around the world, and subsequent dollar appreciation against the major currencies, which we've started to see ease off a little bit just in the last couple of days. In addition, the Bank of England announced a 200 billion pound to 645 billion pound monetary stimulus package. The European Central Bank announced a 750 billion euro program as well. And then sort of starting things off on March 15th was the unexpected intra-meeting FOMC rate reduction, which brought the target federal funds rate down to 0 to 0.25% as the target range. So it's hard to sort of overstate just how massive the policy response has been, both on the monetary side and fiscal side. But the question then is it going to be enough? And what is the expectation for sort of short-term economic growth? And the forecasters are not optimistic. This chart shows the forecast for expected contraction in US gross domestic product in the second quarter of this year, so April to June. The expectations run from a median of around 12% contraction, excuse me, to up to a 30% projected contraction from Morgan Stanley. Even at the median level or below, this would be, you know, a massive contraction in the U.S. Economy by historical standards, where even during the Great Recession last time around, I think the max quarterly drop was around 9% at its worst. And so, you know, always take the forecast with a grain of salt, but the consensus is certainly that we're going to see an extremely sharp contraction in economic activity in the second quarter. So not too surprisingly, markets weren't all that thrilled in their response to what's been happening in terms of economic reports and the labor market. I won't dwell on this because everyone's pretty familiar with what's been happening in the stock market, unfortunately, but suffice to say that, you know, from its peak in mid-February when the Dow Jones closed at 29,551, we saw a drop of about 10,000 points, or about a third of the value of the stock market by the 20th of March. Over the last week, we saw some strong recoveries on, let's see, Tuesday alone, the Dow Industrials were up more than 2,100 points. On Thursday, they were up another 1,350 points, but just the volatility in the marketplace is just astounding, of course. And even on the upswing days, it still raises concerns of just about how much investor uncertainty there is out there and how much more room there is to potentially fall. That's on the equity side of it. On the commodity side of it, certainly it hasn't been a good year or a good month on the commodities front. The Bloomberg Commodities Index year-to-date return through this morning was down 22.7%. Certainly there's been a variety of performance amongst the different commodities that make up the commodity basket within the Bloomberg Index. And crude oil prices have been the worst performer of the bunch again, this is fairly widespread public knowledge, but just to, again, set the stage, NYMEX crude oil futures were trading as low as $19.27 per barrel yesterday, which is just as unbelievable, considering the fact that until end of last year, beginning of this year, we were looking at prices around $60 a barrel. Reuters was reporting yesterday that the price of oil is now so low that it's becoming unprofitable for many oil firms to remain active, analysts said, and higher cost producers will have no choice but to shut production, especially since storage capacities are almost full. Of course, this has, huge knock-on impacts for the steel industry, for pipe producers, but also for ferrous scrap processors, whose scrap would eventually go into oil sector products, as we see this slashing of crude oil prices as Saudi Arabia and Russia can't seem to agree on production levels. And as we're seeing, huge drops in demand for gasoline and other energy products. I know personally that I haven't put gas into either my car or my wife's car in at least a week. And that's, happening across the country as we're seeing the simultaneous excess supply coming out of OPEC. And at the same time, this, huge pullback in US and global oil demand. So that Reuters piece was quoting one of the UBS oil analysts who was saying that global oil demand is evaporating on the back of COVID-19 related travel restrictions and social distancing measures. In the near term, oil prices may need to trade lower into cash cost curve to trigger production shut-ins to start to prevent tank tops to be reached. So that's oil and commodities. Just looking at foreign exchange trading as the last segment of this market reaction. Certainly we saw huge appreciation of the dollar against major trading partners like the euro and the British pound. That has started to ease a little bit as we see some of the coordinated monetary policy actions to provide access to dollars. And I think today the euro was back up to around $1.10, and I believe the British pound was up to around $1.24, $1.25, was significantly higher than where they were trading just a week ago. Okay, so that's the economic and broad market context. Let's delve into the metal market specific developments, and then talk a little bit about what ISRI is doing, and I'm happy to take your questions. So not too surprisingly, we are seeing US steel production starting to drop off significantly. The American Iron and Steel Institute, as you probably know, puts out weekly steel production figures. Those are based on estimates from a survey that they send out. I think they get about a 50% survey response rate, and the rest is based off of monthly production reports. But even having said that, for the week ending March 28th, they reported that US crude steel production was down 12.7% year on year, and down nearly 10% from the previous week, ending March 21st. Again, for the week ending March 28th, the capacity utilization rate had dropped to 71.6%, and that was down from 82.2% 1 year ago. And these steel production declines, not too terribly surprising, given some of the production cuts announced by some of the major steel producers in the United States. And these announcements, and there's certainly been more than just these, but these were some of the more recent ones that Argus Media was reporting on last week and over the weekend. Just to quickly go through these, US Steel announced that it's going to idle the blast furnace at Gary Works and one at the Granite City in response to the coronavirus. The Gary Works furnace had been slated for a 48-day outage starting in April anyway. The steel maker also cut its capex by $125 million and increased its borrowing under its revolving credit facility by $800 million. The EAF at Fairfield Works remains untouched and on schedule to begin melting in the second half of the year, according to the latest reporting, again from Argus. AK Steel will begin idling its Dearborn Works in Michigan on Monday in response to the auto sector shutdown. There's also been a public push from lawmakers that shut the plant over concerns of coronavirus spread. ArcelorMittal will also idle a blast furnace at Indiana Harbor West, and Gerdau idled its EAF special bar mills in Michigan and Arkansas, but said it will restart the Arkansas mill late in the week. All told, there won't be much of a scrap buy in Detroit in April, is the expectation. Gerdau also idled its Georgia merchant bar mill through the end of March. Two other company reports of note. Ford Motor Company said this week it plans to restart some of its operations by mid-April, but Caterpillar reported that it is shutting its two foundries this week temporarily. So that's sort of some of the recent US market developments. Looking more globally, IHS Markit does report on global steel user sentiment, and not too surprising, sentiment was dropping significantly already in February, which is the latest report. The expectation would be that you would probably see an even sharper decline for the March report. According to that global steel users PMI report, the coronavirus outbreak had a dramatic effect on global users of steel in February. The seasonally adjusted global steel users purchasing managers index, which is a composite indicator designed to give an accurate overview of operating conditions at manufacturers, identified as heavy users of steel, fell to a post-financial crisis low of 45.5 in February from 49.4 in January. For the year 2019, ferrous scrap market exports from the United States were actually up. And this chart shows actual market gains and losses by major destinations overseas that have been buying US ferrous scrap. Obviously, the global landscape has changed considerably in terms of trade and transportation restrictions that have been put into place, but still thought it might be of use to see prior to this downturn as a result of the coronavirus spread, where we're actually seeing market growth for ferrous scrap globally, and hopefully where we will see a return to growth once we get through this crisis, including increased demand from South and Southeast Asia, including Bangladesh, Vietnam, and Malaysia, as well as Turkey, which has not only been our largest overseas market for ferrous scrap, but also was the largest growth market last year in terms of net volume increase. And I think the expectation is that some of the import restrictions on steel imports from Turkey into the United States were to be relaxed, that you would see a rebound in Turkish ferrous scrap demand from the United States as a result. But we'll just have to see how that plays out. Just going back to this one slide, you see that China was actually the second largest market drop-off for ferrous scrap exporters from the US last year. Not too terribly surprisingly, China hadn't been one of the major players in recent years in terms of ferrous scrap exports anyway, but their share has actually been decreasing, and it's been decreasing obviously across all the different commodities. This was an article actually that just came out in the Wall Street Journal this week, where they had interviewed the finance chief from Waste Management, and they had used our data as the source for creating this chart, which shows total US exports by year across paper, plastics, and metals in in black, and then the blue section of the bars is China's share of those total US scrap exports. And you can see the dwindling share of Chinese demand as a proportion of total exports across the major recycled commodities. So not only has China been taking in less material over the last several years as a percentage of total US scrap exports, although I think the reports that we hear from a lot of market participants is that China has actually come into the market in the last couple of months as their domestic collection and generation of scrap has been sharply diminished, creating the need for them to import more material, not just on the metals front, but also on recovered paper and fiber and other recycled commodities. And so sort of one of the unexpected consequences, I think, of this economic downturn has been that China's demand for recycled content has actually been on the rise. Unfortunately, Chinese quotas still stay in place, and new trade restrictions have been put into place in other key markets and key growth markets, including India's shutdown that was announced last week, and ISRI put out a member alert about that over the weekend. I'm not going to read this entire slide. You'll have access to it later, I hope. But if you have any questions about the shutdown in India and what the implications could potentially be in terms of demurrage and other charges that exporters might be facing, I'll be happy to share what limited info I might have on that. Just sticking with impact on scrap commodity prices now. These are the latest producer prices for scrap that come out actually from the Labor Department. For February, they were already showing iron and steel scrap producer prices were down 7% month on month. The expectation is that we're going to continue to see softness both on the iron and steel side and on the non-ferrous scrap side. What's not included in that chart is producer prices on stainless steel scrap. And this is the trend that we see over the last several years, including into the first 2 months of 2020 for the producer price index for stainless and alloy steel scrap. Again, continue to face falling prices on the stainless side of the equation. One, as nickel prices have certainly come under pressure this year. After having been the star performer last year, nickel prices have been basically the worst performer amongst the major base metals for most of this year. But also we saw diminished overseas demand for stainless steel scrap from the United States last year. So according to the official trade numbers from the Census Bureau and the International Trade Commission, which are admittedly are imperfect on the stainless steel scrap, even so, they showed that our stainless scrap exports in 2019 fell to the lowest level since 2002. Just a little bit on the stainless market conditions before moving into the non-ferrous market conditions that we're seeing. And again, just going back to the global PMIs for copper and for aluminum that IHS Markit puts out, I think they're pretty illustrative of how things were going market-wise through February, which is their latest report. Talk a little bit more about what's been happening since then, but just on the copper side, they were reporting that central to the copper downturn was the emergence of the coronavirus outbreak in China, which led to a number of factory shutdowns. As a result, output at Asian copper users contracted at the sharpest rate for over 11 years. Production at European mills, meanwhile, fell modestly with the rate of decline the slowest in 13 months. Concurrently, US users saw a solid expansion in output in February. And I think there were a number of sectors within the copper and copper alloy fields, including ammunition, but other sectors where demand has reportedly actually been much better in the United States than in other markets, and much better than in other commodities, especially those closely connected with transportation like the aluminum sector, which I think is continuing to face significant obstacles. And IHS Markit reports about that. They say the seasonally adjusted global aluminum users purchasing managers index, a composite indicator designed to give an accurate overview of operating conditions at manufacturers identified as heavy users of aluminum, fell to a 131-month low of 45.6 in February from 49.7 in January, to signal a steep deterioration in the health of the global aluminum using industry. And again, the expectations are that even though as China gets back to work a little bit on the manufacturing side, that the March PMI numbers are going to be dispiriting as well. Again, this is the US exports of copper and copper alloy scrap over the last several years, just to show you the trend, because as I said earlier, certainly market conditions are changing quite quickly, especially with expectations of what's happening in China and sort of China's attempts to relax some of the import restrictions on the high quality copper and copper alloy scrap and aluminum scrap, which are expected to come into place in July. Even still for full year 2019, and again, the first month in 2020, Malaysia has been indicated as the largest export destination for copper scrap from the United States, followed by Canada, and then China, South Korea, and India. I don't think too much about potential transshipments of material that is designated for one destination, but eventually finds its way into other markets. But it is fair to say that trade restrictions and travel restrictions that are currently going into place in these major overseas markets are having a significant impact. And we're seeing the impact of these downturns in copper and non-ferrous, both primary and scrap demand, certainly at the exchanges. Over the course of just 1 week, from March 13th to March 20th, the price of copper at the London Metal Exchange dropped by more than 12% in just 1 week. And all base metal prices were down between 5 and 12% over the course of the week. I think for the year to date, copper is down something like 22, maybe 23%, depending on where prices are today. But again, this makes it extremely challenging, not just on the primary side of the equation, but on the secondary and scrap sides of the equations as well. To give a more recent update as to where prices have been trading, recent market conditions, and the outlook for the major non-ferrous metals, I'm going to turn to this report from ABN AMRO. But just to be perfectly clear, and certainly from the antitrust perspective, these are not ISRI price projections. And I know Wayne gave his disclaimer at the beginning, but just to be clear, these are not our price forecasts. We're not in that business, but thought it might be interesting to some of the listeners today to hear what some of the expectations are for prices going forward. So just looking back to the last week in New York, COMEX copper futures actually plunged as low as $2.02 a pound in intraday trading on Monday, before stabilizing around $2.15 to $2.20 late in the week. Similarly, LME 3-month copper and aluminum closed last week at $48.15 per metric ton for copper, or about $2.18 a pound, and around $1,552 a ton for aluminum, or about 70.4 cents per pound. ABN AMRO reports that base metals supply and demand fundamentals have deteriorated sharply. End users in construction, mechanical engineering, and automotive sectors have shut down facilities. This dampened demand while this output remained elevated. This means high availability in the short term and will keep prices relatively low during the second quarter of this year. So their projections for second quarter prices for aluminum, they're looking at an average of $1,520 a ton. For copper, they're looking at an average of $4,912 a ton. And for nickel, they're looking at an average price of around $11,300 a ton. and you can see their price forecasts, not just for this coming quarter, but for the out quarters through the fourth quarter of 2021 in the table on this slide. Okay, that's I think what I had to say basically on the commodities, on metals, both primary and scrap, and also the larger economic context. I wanted to give you all just a quick snapshot of some of the things that ISRI is working on for the industry that may be useful for you in your work and for your companies. ISRI certainly continues to closely track policy developments both at the federal and the state level, and there's been a lot of state level activity to keep track of. In our state folks, Danielle Waterfield and Justin Short, have been doing a fantastic job keeping our members updated on what's been happening at the state level, because things can be enforced and enacted so much differently from state to state. But ISRI is also providing timely analysis and guidance to our members on what these announcements mean for your business. ISRI petitioned for inclusion of metals in the FMCSA emergency declaration. ISRI requested national essential designation for U.S. recycling operations, which has been key. ISRI's got a COVID-19 resource hub for additional resources on dealing with the coronavirus, and the site is continuously being updated. Also, ISRI created a podcast video series, COVID-19, the impact on recycling, with the latest news and information. There are a couple of different podcasts up there already, which are all interesting, I think. And then last but not least, we're certainly continuing to put out environmental health and safety and market updates every week. And for more information about those, feel free to give me either a call on the cell, because cell's the best number these days, or shoot me an email at jpickard@isri.org. I think that was plenty for the prepared presentation. Wayne, did we have any questions at this point?
Yeah, we do, but first I want to thank you for providing this information. You know, ISRI is a very great advocate for the recycling industry. We're fortunate to have you guys and to lobby for us and provide this information. And also thank you for those beginning slides. I know it wasn't market related, but I think all that information does drive the eventual markets for metals and other commodities. So thank you for that. So you know, back to those few first slides, there's one question here on how is a small business defined?
That's a very good question. So it varies by industry. So the Small Business Administration has different thresholds. And I only know this off the top of my head because I was asked this question earlier about, so under the SBA rules, different industries have different definitions of what constitutes a small business. So it's done basically by NAICS code. And so there are two main NAICS codes for that most recyclers report under. The one is under the 49203, which is wholesale merchant recyclers. And SBA defines that as 100 employees or less. The other main code that recyclers report under is under material recovery facilities. And for that one, it's not by employee, it's by annual sales. And the cap for that, I believe, is 22 million. So depending on whether you're reporting under merchant wholesale recycler or materials recovery facility, it's either 100 employees or 22 million in annual sales.
Okay. So if you do have a question, I know some people are raising their hands, but we're not unmuting the attendees at this point. So if you do have a question, use the chat feature and type in your question, please. We appreciate that. So this question says, given the low prices for energy, steel, and other materials and growing unemployment, would federal support for infrastructure, repair, and expansion be both affordable for the feds and beneficial to construction companies and their employees, as well as beneficial to the recycling industry and the economy as a whole?
Well, those are two good questions. The first one is whether it's affordable, and the second one would be whether it's good. And it reminded me of a question that I got on a conference call yesterday, and I think the question was, as they're coming up with these stimulus packages, is anyone concerned about what the long-term implications are for our federal debt or for inflation, in the years and decades ahead? And this goes back to the affordability part of your question. I don't think affordability is really a concern right now in terms of policymakers. I think they're just going to pull out all the stops that they can come to agreement on in order to pump as much stimulus as they can into the economy to try to avert, economic recession or depression, or minimize it to as much as they can. In terms of whether it would be a benefit, I think it absolutely would. In terms of raw material demand and demand for recycled commodities. I know, lots of folks have been pushing for an infrastructure package, and there's been, little agreement on it, but I think it would certainly provide a boost for all the companies and sectors that you had mentioned in your question.
Okay. That's it for the questions for now. I'm just waiting for some to come in right now.
And like I say, if anybody's got questions subsequent to this, I know sometimes it's not everybody wants to ask questions while we're online. Like I say, feel free to shoot me a line or give me a ring. I'm happy to discuss.
I want to see if I can allow Wayne from Minnesota to talk here. He raised his hand.
Okay.
That doesn't let me.
No. Sorry, Wayne.
Can you hear me?
Oh, Wayne, you there?
Yes.
Okay, go ahead.
I wanted to. Not working. Too much feedback.
I think if you're using audio from your computer and from your phone, that would make the feedback worse. Wayne Bowen, can you?
Yeah, we got a feedback issue, so that's not going to work. Our apologies.
No worries.
Okay. Any more questions? Okay, so like Joe said, he has his contact information there, and this webinar, as well as all the other webinars in this series, have been recorded and will be made available via YouTube links on both the National Recycling Coalition and the Pennsylvania Recycling Market Center websites. Thanks again for joining us, and we hope you'll join us for next month's webinar. And please visit the NRC and RMC websites for schedule updates. Before I sign off, we do have one more question, so we'll do that before we sign off.
Sure.
Well, this question is for future webinars. They asked if they're going to be doing different commodities, and the answer is yes. We're doing plastics next month and paper the following month. So we're going to be doing this commodity series right now. I think it's very important given the current condition of the economy. So with that, I'm going to sign off. Again, thanks for visiting the webinar, and join us for next month, please. Have a great day and stay safe, everybody.